So let's start. So this is the last session of the whole day, and this is again exciting topic. Often the case I attended, and I assume that many of you attend a very stimulating conference. I attended last few weeks 2 conferences. One is, actually 3. One is NAIC International Forum. Another one is European Colleagues Insurance Europe Conference. And one is Geneva Association's CEOs Conference. And all conference, one common theme is fintech and cyber. In other words, industry has a huge attention of new technology, and the attention of the new technology is very, very natural, because new technology, simply put, fintech create a huge business opportunities, and it's exponential opportunities for the business. So CEOs, companies focus very much these opportunities. But also these opportunities create huge exponential risk. And this is cyber. Cyber risk is a huge issue for the industry and also regulators. So this is very topical and exponentially important for not only industry, but the regulators. So my role here is to introduce my panel leader, Moderator Takashi Hamano. My compatriot, and I really have respect of his work. He's not only chairing or vice chairing or executive committee, but he attends all the relevant committees, subcommittees of IAIS. And I'm very much sure he's the most attended person in all IAIS key meetings in the whole IAIS. So he knows from the bottom to the top of IAIS activities, not only this subject, from GSII, ICS, ICPs, from this stakeholder involvement to Asian Forum of Insurance Regulators. So he has a long career background of Bank of Japan, and now he moved to JFSA, Japan FSA, as Assistant Commissioner. So with this, Takashi, floor is yours. Thanks.
Good afternoon, ladies and gentlemen. I hope that you are not too tired after many exciting panels. So I'd like to start this panel on cyber risk and cyber insurance. To begin with, let me briefly explain some issues concerning cyber risk and cyber insurance as an introduction. So, as we all know, cybersecurity incidents are increasing in both frequency and severity, and concerns over cybersecurity in the insurance sector have been growing as insurers hold substantial volumes of personal information that can be a target for cyber attacks. For that reason, the IAIS has recognized the increasing risk to insurers and their customers from cyber incident, and this led to the work on the IAIS on issued paper on cyber risk to the insurance sector. So this paper aims to raise awareness of the challenges presented by cyber risk in the insurance sector, and the public consultation on this paper was recently completed, and we are expecting to finalize the paper in late July. So you will have a chance to look at the final document. So this paper delivers a number of messages, and well, let me raise the 4 points here. So number 1, cybersecurity incidents in the insurance sector may result in severe harm to policyholders and significant legal, regulatory, and operational costs, including reputational damage. The insurance sector as a whole may be affected by a loss in public trust for this incident. Number 2, the growing frequency and severity of cybersecurity incidents, as well as interconnectedness, means that cyber resilience must be a concern for all insurers, regardless of size, business models, domicile, or geographic reach. Number 3, insurance supervisors have an important role in enhancing cyber resilience in the insurance sector. The nature of cyber risk requires increased scrutiny of supervisors and also requires increased cooperation between and among the public sector and the private sector. And number 4, Although the ICPs provides a general basis for supervisors to address the insurance sector with respect to cyber risk and cyber resilience, additional guidance from the IAIS addressing cyber resilience best practices in line with the ICP may be helpful for supervisors and insurers. And now turn to an issue on cyber insurance. The IAIS also conducted internal research to understand the development in the cyber insurance market. The market is relatively small now, but it is growing rapidly. But despite its potential, there are several challenges for cyber insurance market, and we have identified several challenges, and let me raise just 3 points here. Firstly, because cyber risk continually evolves, this may present underwriting challenges for insurers. Number two, the relative lack of historical claims and other actuarial data also poses challenges, as does the current lack of standardization of contractual terms. Thirdly and finally, the cyber insurers are confronted by potentially substantial accumulation risk. I think those points will be taken up by the panelists. And now turn to the introduction of the panelists. And we have today 5 very distinguished panelists. Well, 1 insurance supervisors, 2 industry practitioners, 1 modeling expert, and 1 think tank researcher. So this well-balanced panelists would address the many issues I raised from different angles. So to begin with, in my left is Ms. Anna Maria Dolster. As you may know, she's Secretary General of the Geneva Association, the leading international think tank for the insurance industry. Before joining the Geneva Association in 2014, she was responsible for the insurance practices at the Swiss Quant Group, and she also assumed the leadership position at the Baloise Group in Switzerland and Europe. Next is Ms. Maya Bundt. Maya is the head of cyber and digital strategy at the Swiss Reinsurance. In this role, she is responsible to develop and implement the reinsurance cyber risk strategy and to drive digital innovation and initiatives. Maya has been with Swiss Re for 13 years in different strategy and IT initiatives. And Maya Maya holds a PhD in environmental science from ETH Zurich. To her left is Mr. Robert Duncan. Rob is the Chief Information Security Officer for Directline Group. It is a UK-based insurance company, which is a kind of forerunner on online insurance service provider. And in his role, he's responsible for security architecture and engineering, security enablement and awareness, and cyber intelligence. Prior to joining the Directline Group, he was the Chief Information Security Officer for Euronext stock exchanges. And also he also had a leadership position at the UK Prudential before that. Then his left is Mr. Domenico Del Rey. Dom is the director of PwC UK. Dom leads a team of actuaries and catastrophe experts in PwC's Actuarial Services Department. As part of his work on cyber risk management, Dom leads a team which brings together the expertise on cyber security and insurance that lies across the disciplines in PwC. He is engaging with reinsurers and primary insurers on their proposed plan to grow and manage their exposure to cyber in the current books, as well as the specific cyber policies. Finally, I would like to introduce my fellow supervisor, Mr. John Huff. John is the director of the Missouri Department of Insurance, Financial Institutions, and Professional Registration. He assumed his position since February 2009, and John was elected by his peer state insurance supervisors to serve as the 2016 NAIC president. And also, he used to be the representative of US state insurance supervisors at the US Financial Stability Oversight Council, created by the Dodd-Frank Act. So this panel will be organized in this way. Firstly, I will ask each panelist to explain their own views using PowerPoint slides. I assume that each presentation will take about 8 minutes. Then I will ask a few questions as a moderator. Then I will open the floor for the question. So now I turn to Anna Maria for her
Thank you very much, Takashi, for this nice introduction. I will dive into a piece of research that the Geneva Association is working on for the moment. We're doing research together with the University of St. Gallen, and what we're doing is stock taking of all the studies and articles that have been published on cyber risk, cyber insurability, and cyber, but from an economic, risk management, and insurance point of view. We bring these together in a database that is sortable along the different notions, and also we go through these studies, we do the review of them, and the insights we get out of these, and by now it are 200, we will bring them into a paper together. Bundle all these insights. The paper will be ready by the end of the summer, as will be the database, but today I'll give you a first view on our insights on the cyber risk. We structure, I'm going to jump because I only have 8 minutes. We structured the whole research along 10 questions that came up in all these different studies. These are the 10 questions. These are the core questions that have been treated. However, as we have a limited time, I'll just touch upon the ones in bold and give you a general overview on them. The first one is, what is cyber risk? Is there a definition? Out of these studies, we get to a common definition that is any risk from the use of IT systems that affects the confidentiality, the availability or integrity of information systems caused by an activity, criminal or not. Some studies take an approach to make a differentiation between macro cyber risk and micro cyber risk. Macro is more the kind of cyber warfare, terrorism, where really there's cyber attacks aiming at infrastructure that is vital for society. This generally can be performed by terrorists or governance with a political or technical motivation. And micro tends to be more directed towards private systems or business systems and more with a financial motivation. The cyber risk is a bit special. It has a couple of characteristics that are different from other risks. First of all, there is an interdependency. It is correlated with other risks. It is not an isolated risk, as it very often is with the other risks that we insure. The potential for extreme events, so it can be short tail, it can be long tail. There's a high uncertainty still with respect to data and modeling approach. And it is a changing risk. There's a risk of change or a changing risk because technology evolves. Now we're going to see the Internet of Things, with this blockchain coming up, so that creates different kinds of cyber risk. Is there data? Yes, there's data, but it's limited data from different sources, raw data or aggregated data. However, in the United States, since 2002, the US entities that experience cyber security breaches are required to report these incidents to their customers and to other parties that work with enhanced data availability. So there's a reporting history from breaches, not losses, but breaches, for 14 years in the United States. In Europe, the situation is different. In Europe, there is a European Network Information Security Directive that is on its way, that will be implemented and become valid in May 2018. And that directive will make it mandatory for companies that are active in the EU and that treat data of EU citizens to inform regulators of cyber breaches that have occurred within 72 hours, and they have to inform about the breach, how it occurred, and what they want to do about it. So there is more data that will be built in Europe from 2018 onwards. However, the caveat is that cyber data is very fast evolving and it becomes obsolete very, very fast as well. Now, an issue that is being treated in research very often is how do you do cyber risk management? The insights we have from the papers that we went through is, first of all, transfer is a difficult issue because there's not so much product or not so much transfer insurance coverage going out for the moment or out there for the moment. It's more about focus on control and prevention, and you have to institutionalize it at the C level in the company. The role of Chief Information Security Officer is a role that becomes more and more common, and companies that have such a Chief Information Security Officer tend to have breaches that are 30% less costly than companies who don't have one. Then it is important to define a security standard you want to stick to assess your situation. What assets do you have? What threats are there? What are the sources of these threats? Do an impact simulation and analysis, and don't forget the reputational risk. and have a continuous dialogue with the stakeholders. Cyber risk is not an isolated IT risk. It is a risk that is spread around in your company and outside of your company. It can come from customers, it can come from providers because the systems are interrelated. And also you should really make your employees aware of the situation where the cyber risk can occur and do trainings for them. Have operation plans ready, emergency plans ready when a breach occurs, and also continue to monitor the situation. Is there an insurance market? So can I buy protection for cyber risk? Yes, there is an insurance market. It's a specialized and small market. Again, there's a difference between the United States and Europe. In the US, the market is a lot larger than it is in Europe. In the US, it is estimated by the end of 2015 to have a gross premium volume of $2.8 billion, and it grows 30% a year approximately. In Europe, the end of 2015 is estimated around $180 million, but with a perspective of growth to 1.1 billion by 2018, according to a study of the NAIC. The main reason for the US being or having a more developed market is that data collection. So there is data available to quote and to price. Also, the products that you find in the market are very specific and they change fast. They're specific because they ensure a certain risk that can be identified in a certain industry with a certain company. And very often they have specific exclusions or caps because the risk is difficult to assess still. Hurdles to insurability, I've touched upon them. This is not lack of data. The risk changes. There's an accumulation. I mean, by the world becoming more and more integrated, the systems becoming more and more integrated and becoming more standardized, you have the risk, of course, that it spreads faster and spreads more broad. And there is a moral hazard issue because you can really try to do prevention in your company, but still it can happen because your customers and your providers didn't do prevention. So it may perhaps be better not to do any prevention and buy an insurance. That's the risk that the insurance have to deal with and look into that generally by doing analysis before underwriting. So very briefly now, what can the insurance do, industry do to prevent cyber risk and to support the development of cyber insurance? First of all, it is a lot about the lack of standards, the common language and the best practices. So it's developing a standard, a common language, best practices. Also, perhaps define and risk assessments for potential policyholders, standardize that, look into the severe loss scenarios, where are the probabilities at the tail, follow up on technology, what's going to happen, what are the risks coming out of blockchain, for instance, and also support eventually an anonymized data pool, as there is little data, perhaps share it, or develop a reinsurance pool, especially for the macro cyber risk, and keep the existing policies up to date. So far, my brief introduction.
Thank you, Anne-Maria. So Maya, now I listen to you.
Hey, can you all hear me? Yeah? Excellent. So I just need this thingy, I guess. Good. So let's hope I find the right buttons. No, that wasn't it. That wasn't it either. And that was the out button. The big green one didn't work first time.
This one.
This one.
Yes.
It's another big green one. Okay. This is a Janus hat. Oh, I have to stay here. This is a Janus hat. I'm sure you know this. It's somebody, actually it's the same person, looks into two different directions. The thing is, those faces, they don't talk to each other. And this is why I kind of like it. It's a nice picture of what happens in many insurance companies nowadays. So one head actually looks internally. It looks onto the operational risk that every insurance company faces. Every insurance company has data, has processes, has some of these assets that should be kept internally and should not get out. So there is a risk that those assets are being, exposed. There is a risk that operations are interrupted and the insurance company cannot work anymore. And there's usually an IT department who looks at that and looks after those assets and looks that operations are running flawlessly. Now the other hat looks to the outside, looks into the market and says, ooh, there is a risk. And where there's a risk, there's an opportunity for insurance companies. So companies nowadays write actively cyber risks, and they also don't actively write cyber risks, but still have cyber risks in their books, and I'm going to explain you what I mean with this. So I have some experience with this hat because I've been on both sides. When I started in IT at Swiss Re, I looked to the right-hand side, right? I was responsible for our internal control framework, for our IT governance. And I very much looked into that and did everything in order to keep Swiss Re and our data and our processes and our operations safe. And then I changed sides, and now I'm on the other side. And I look into, okay, how can we underwrite cyber risks actively, and how can we also make that a sustainable and profitable market in the long run? And that's not easy. That is not easy. Now, one of the problems that we have in this, and Anna Maria talked about it already, is there is very little data available. And there's not only very little data available for the left-hand side, for the underwriters, because all know underwriters, right? They love like 100 years of data, huge databases, actuaries especially, they just love data. That's cyber risk. There is data available, yes, now 10 years maybe. It's very patchy too. Thing with cyber risks as well is what you have seen in the past might not be a very, very good predictor for the future. So there are, things on data that we need to solve. We also have problems on the operational risk side, because until now it is not really possible, well, probably with a lot of force, to squeeze cyber risks in the current operational risk frameworks. And this is why we have set out with the CRO Forum, a cyber work group that has been going on for, well, the best part of a year now. And what we have done is we have developed a classification scheme for cyber risk. And the great part about this, and I love this, is it connects both sides. It connects these two heads that are looking into two different directions. It connects them on that impact. So the idea is you come from the right-hand side, right? You have this Janus head. You have this Janus head looking to the right. You come and you have an incident. Now you can, or you should then collect those data in any given company. And what we are doing with the CRO Forum now, we are starting a trial period where all the companies that are part of that CRO Forum try this concept out. And then we will hopefully be able to implement that far wider than only insurance. Because this way, any company is able to collect data, actually operational risk data, on their cyber risk, on their cyber incidents. It is based on already existing frameworks, uses Basel II as a basis, but adds to it. So I think the data that we will be able to collect here will be much richer than anything that we had in the past, and will give management then also decision basis. Where do we need to invest more in terms of also cybersecurity? Where does it make sense to maybe include more trainings into the organization? And where does it make sense to buy more insurance? Now, the connecting piece is that impact type, because something has happened. There was an incident. It was analyzed. All this data was collected. And then there is an impact on the organization. And that can be that, data was stolen or copied. It can be that the operations are not working anymore because the system is not working. It can be anything. And this impact and that potential loss might or might not be an insured loss. right? And this is where it all comes together. So if you look at, again, think back to the Janos head, that one looking to the left side, you come from the left side and you basically can also use that framework, because once you have that insured object and that insured loss, you can see what was the root cause, where were the actors, what was the event type. And over collecting all of this data, you will be able to get a much better picture of what we're talking about here. It will also allow people to talk to each other. It will allow the operational risk side to talk to the underwriting side, and it will allow actually for some data sharing. Worldwide, there are many initiatives currently ongoing that deal with data sharing. Can we share data? And Anna Maria alluded to it. Does it make sense? What kind of data? This framework defines what kind of data could be shared. So I'm a great fan, so I hope you noticed. Now, once we have all that data, we can do things with it. And I've brought you this picture just to lighten up the mood, because you've been sitting in this room here for a full day. Anybody know who that is? Yeah, that's a bald eagle. We call it a sea eagle in German. That fellow was almost extinct in the 1960s. And he was extinct because we used all over the world a chemical called DDT. It was an insecticide. It was a great insecticide. It was developed after the Second World War and was used everywhere. It was great. It killed all those insects. The problem was a metabolite of this insecticide called DDE accumulated in the food chain, and especially in aquatic food chain. And this guy ate the fish. And what happened then was it couldn't breed anymore, because all those eggshells were too soft. And once the female laid the eggs and sat on the nest to hatch the hatchlings, the little eagles, the eggs would break. So that almost killed completely the population of these eagles. Now, why am I telling this story? I don't want insurance to be the sea eagle. I don't want insurance to be extinct. And cyber risk actually has a distinct potential for accumulation. And Anna Maria showed a little bit of the definition of cyber risk. Now, when you look at cyber risk in an insurance company, in an underwriting portfolio, you have the cyber risks that you write. Basically, you write data breach covers, you write business interruption covers due to non-physical business interruption, you write cyber extortion, these kinds of covers. You analyze them, you price them, you look at them, you manage them. That is one piece of the story only. The other piece is where cyber risk comes in as a peril to other lines of business. And that is a piece that is currently being looked at by many insurance companies, where especially the big ones and also the reinsurance companies, obviously, we are building models in order to be able to look at those silent covers. I think there's also a lot of work to be done in terms of wordings. But this piece is, I would say, at least as important as the other piece. And we need to look at it with as much eyesight as we look at the explicitly written cyber business. So in order for our insurance industry to keep healthy and fly, we need to look at the accumulation potential in any given insurance portfolio. The problem with cyber is it's not so visible, right? In an earthquake sense, you can define those houses. They sit on a fault line, or they sit in a windstorm corridor or whatever. For cyber, those confinement dimensions are much more underlying, much more difficult to discern. So I think we need to look at the explicitly written cyber covers. We need to look at the silent cyber covers, and we need to monitor and steer those accumulations. And I'm pretty optimistic that we will get there because a lot of companies, insurance and reinsurance companies, are actively working on these topics and making big progress as I speak, actually. But the work is not over, and I think we will be pretty busy for the next couple of days. Days would be nice, years on that. So yeah, this was my 3 points that I wanted to make. Thank you very much.
Thank you, Maya. It's a very visual explanation. So I'm now down to Robert.
So first I'm going to make sure that I get the right green button here. But
big green one.
Okay, I've tried both green buttons, so I'll get there eventually. But okay, I think I got it now. So just to introduce myself, I'm the CISO for Directline Group, which is a FTSE 100 insurance company in the UK. I'm actually a practitioner, so I'm not on the insurance side, although we do have a cyber product. So I thought I would talk a little bit about today, just about what I see in my role as a CISO and what I think could impact the future of cyber insurance. So just a quick thing about the Directline, and this is put together by my lawyer, so I say the right thing. We're a FTSE 100 firm. We've got 11,000 employees. My cyber team itself is around 60 people, which is, I think, about right if you baseline the structure of my team versus other insurance companies. So I wanted to start out with a couple hypotheticals for people in this room. The top firm is the way that I would argue most cyber insurance firms would say you should structure a cybersecurity firm. So you would follow best practice, you would be audited very heavily, you would work a lot with your second line risk team, and you would have tons and tons of paperwork to prove how good your cyber insurance is. And I would argue if you put this in front of an insurer, they would give you a pretty good premium. The second firm at the bottom, I think, is the direction of where at least practitioners are going. So this is threat-led type cyber defense. It's a bit less based on frameworks. Frameworks are still very important. Much more based on partnership with the business. So to give you an idea, firms at the top tend to spend about, CISOs like myself, would spend 50 to 70% of their time talking to their audit teams, their regulator, their second line risk teams, their board, and their executive team to give them assurance that you're defending your company. In the meantime, myself and my team aren't really doing much of actual work. So I think, in my own opinion, the second structure is the direction the industry is probably going to go to. So the reason I think this, and the reason this is proven out by recent attacks, by the way, is that most organizations are structured in the way things are supposed to be done, the way things actually happen. So most companies have security policies, procedures. I'm sure you all love your password rules that you have to follow at your own companies. The reality is most people don't always follow policy. They don't always follow procedure. The reality also is that sometimes if you have to get a product out in 3 weeks, you are told you need to do what you can to get it out, right? So the reality is when you run a cyber team like I do, I think you have to spend a lot of time influencing. You have to spend a lot of time in what's called the below the waterline part of an iceberg, the way things actually get done. So I could give you a really simple example, and this isn't anything related to my company, it's an example. I know of cases where a policy might say, don't click a link in an email. You all probably have that. I also know of many cases where employees have done it. Those links then might say something like, you're a victim of ransomware, please make a payment. I know every company would say, don't do that if you're an employee. I also know many employees would do that because they don't want to get in trouble with their line manager. So again, I think the future is very much about influencing that bottom part of the iceberg. So really quickly, this question comes up a lot. It also comes up when insurers interview somebody like myself in terms of what kind of premiums to charge me. Are you paying enough? Do you follow what's called the lines of defense model? So this is an example from history. This is the Maginot Line. Everyone's aware of it, I'm sure. It had roughly 27 layers of defense. Phenomenal piece of engineering, amazing, didn't work, as everybody knows. In reality, however, it did actually work. This is a quote from Andrew Maginot himself, the guy who designed the line. The line was supposed to be a part of a wider defense network. However, a lot of the people making investment decisions poured all the money into the line, thought that was enough, and didn't necessarily approve the lighter things like rapid response teams, things like considering if the Germans are going around the line, that sort of thing. This happens a lot in reality. Again, as an example, nothing about me specifically. If I requested £1 million of a special new fancy thing, something like FireEye from my board, probably I would get it. If I asked for 30,000 to get a process person to help improve process, probably I would get a lot of challenge, because then I'm entering a world that a lot of people understand. And in reality, that investment is actually much better, again, for real security. So last couple of things really quickly. I think the industry is going to move towards scenarios. So we do this a lot at Directline. I get time with my executive team. We had a session a few months ago. 7 hours of running through scenarios. What would the CEO do in a certain situation? What would the CFO do? When can I turn off systems? When can I not turn them off? Very great way to really test your systems and figure out how much you can recover, how quickly you can recover, and if your executives are engaged. There's various ones you can do. Tabletop's the easiest, but the more sophisticated firms get into things like full simulations for entire days at a time. These are some examples of the different roles different executives could play. Again, hypothetical, not related to my own company, but it's more about the themes of how you could set up a scenario itself. So the last thing I'll close with, and just to give everyone a sense of why I think it's probably tough to insure cyber, ransomware you've all probably heard about. It's in the news right now. It's terrible at the moment. It's getting worse and worse. This is a timeline of how it's gone. Each of those points, you would have assured the risk of ransomware at much different price points, I would imagine. Even in the last year alone, it's gotten much and much worse. 90% plus of phishing emails that get through defenses tend to have ransomware, for example, so it's very bad right now. Yet you'll rarely be asked that on any sort of cyber insurance question. You'll never be asked that by your panel who are considering insuring you, typically. Now, the way you deal with that in reality, and what I do on my team, is you try to anticipate the newest threats. You then run your simulations. This is an example of what we're doing just at the moment. This is a blog anyone can go to that literally outlines probably a new ransomware threat that could probably hit any corporate in the next couple of months. Tells you exactly how to do it. So you can either depend on your controls or point to your frameworks, or you can actually run your scenarios and see if you can actually stop this kind of attack. The other thing we do, and I would suggest a lot of firms should do, is we do a lot of decision tree analysis. So we assume that, okay, what if a scenario happened? How will we recover? How do we bring the systems back up? If ransomware happens, hypothetically, should we pay the ransom? When do we get law enforcement involved? That sort of thing. And again, I think there'll be more and more of this going forward. So what I wanted to close on, and I think it's really probably important from an insurance standpoint, is I think cybersecurity is actually a wicked problem, which is an academic term, but it basically means problems that are very difficult to solve. Global warming is a very simple example of something that they're not deterministic. It's very clear certain things you should do, but there's other knock-on effects that you can't predict. They tend to have 4 themes. The first is that time's running out. The second key one often is that whatever you do to fix the problem has unintended consequences. So if you take what I do, when I put in a new tool that might mitigate a threat, that often then gets hit later 2 or 3 months by hackers. So the tool I invested in no longer works, or the tool I invested in suddenly has a problem. So on day 1, when I get my insurance, it could be that my defenses can't really be breached. On the second day, it's very likely that I'm completely wide open, and I think that's a big challenge probably for most insurance firms. So what I would say is we definitely need cyber insurance. I would say working for an insurance company, I love insurance, but I think the model itself and how you could price it probably still has a little bit of a ways to go, and anybody that does insure companies probably is assuming quite a bit of tail risk. Thank you.
Thank you, Robert. Then we turn to Dom.
Getting there. Big one. Oh, here we go. So, you've heard from my bio, I'm a modeling guy, and I would normally give my thoughts around CAT models, scenarios, how to integrate them, how to build them, what's available, what isn't available. But actually, I think that was covered really well by both Anna Maria and Maya. So I'm going to tell a slightly different story. I'm going to tell the story of what I've learned in the 18 months that I've been working very closely with my cybersecurity colleagues in PwC. So the guys in PwC that I work with are very similar to the sort of work that Robert does. They manage a lot of the post-breach crises. They do risk assessments. They do penetration testing. They are at the front line in all the corporations that are trying to manage cyber risk. And I've been working with them to effectively do exactly what Maya was describing, to bring the two heads together, to bring how can I get 350 people who know a lot about cyber risk in the front line, make it relevant to my own insurance clients. And actually today I do spend a lot of time with my clients talking about accumulations and aggregations and what the best approaches are. But what I've learned in 18 months is actually really interesting to see the point of view of the consumer. So the point of view of other CISOs like Robert, normally a lot less sophisticated than Robert, and how they are managing with the cyber risk that they are holding. I thought I'd sort of break it out into 6 steps. This is the journey that a CISO or a risk manager in a company will go through. They will want to, it's very simple what I've done here. I've just said, they want to be able to assess their risk. They want to be able to make sure that the investments they're making in improvements are recognized and they're relevant. They want to get protection where they haven't been able to mitigate risks. They realize that cyber risk is a dynamic risk, so they want to be able to maintain that in time, both the risk but also the protection that they get. And then at the time of a cyber breach, they want to be able to have rapid detection and be able to recover quickly, handle the crisis. So if we just flip and now look at where does the insurance sector sit in this, I think the overall message is that the insurance sector is very much at the early stages of maturity. It is not close to the real risk management issues that cyber is giving the corporate world. So if we think of the very first actually is the point that Robert was making earlier. How are risk assessments made? I've seen all sorts of feedback from both the underwriting and the company side of how sometimes it's made on cultural assessments of how what is the mood in the company, all the way to very technical, detailed assessments. And what I've heard most is that actually there's very little linkage between what is described as evidence of good cyber maturity actually being linked with the heads of cover that an insurer would offer. That technical assessment doesn't exist. So as a result, investments are difficult to recognize as real mitigants. As a result, the policies in the market now are not perceived as value for money. The market is small, and it's small for a whole list of reasons, which I think Maya and Anna Maria mentioned earlier, but it's also low because cyber policies are not giving what companies want. And I think that statistic that says that only a quarter of the policies actually offer a loss of revenue cover, I think is quite indicative of that. Usually the biggest impact of a data or cyber breach is the fact that you cannot run your business. And then there's a series of areas that I think are to do with the appetite and the operation within insurance companies, and Maya's touched on these. So one is what we call silent cyber. Some of my clients are not going to write are not going to develop a cyber policy until they get a really good handle of what their exposure is today. This is a big concern. So if you can't do that, then clearly actually writing cyber is not a viable option if you can't measure what's currently on your books. So this is so that's what that little storm with a lightning. That's a cyber catastrophe happening. So then I've tried to think. So what does good look like? So what could a blueprint for a good, healthy cyber insurance market look like? And I've got a front office swim lane, in consulting words, and then I've got a back office one. And I think I'm just going to say a few words about the front office bit, which I think fundamentally one of the best ways to think of what cyber insurance should look like. It should be closer to what credit insurance is. So high expense ratios and low loss ratios. It should be a technical issue underwriting cyber, because cyber is technical. It needs due diligence. It needs a relationship to be built between the cedent and the insurer. So that's, and then there's a whole series of, what does that look like as a front office operation for an insurance company? But just for brevity, I'll just spend a few words about what does this mean in terms of back office. And one of my bugbears is that this is a very technical area, and insurance companies who want to enter this market need to start with a very well thought through assessment of where does their risk appetite sit, what are the industry sectors and the heads of cover that they feel comfortable they can bring onto their books. And this will mean actually building alliances with cybersecurity experts. This happens a lot now at the post-breach stage. There's lots of linkages between insurers and service companies that do post-breach assessment. There needs to be quite a lot more work on the pre-breach, on the risk assessment. As Robert was saying, what are the standards that actually allow an insurer to understand the really good behaviors that a company has, and what appetite they have to ensure the residual risk. I put own cybersecurity because I think in the future, insurance companies, to do a good job, will have to actually acquire a lot of information about their cedents, like core complex risk, like cat risk. They'll have to find out about hardware, software, all sorts of potentially very sensitive information so that they can underwrite. It is absolutely essential that insurance companies are ahead of the pack in their own cybersecurity. Otherwise, the trust just will break down. And then I think of another clearly important back office phase is just how do you make sure that you have good portfolio risk management. And this is, if you think about where the industry was in the natural catastrophe space 25 years ago, after Hurricane Andrew, the same issues were around: the data quality, the sophistication of the tools. We are at that stage now, and we've heard this evening there's a lot of initiatives around the data quality and data means of aggregating data that allows underwriting and portfolio management. I think there are 4 steps in portfolio management. One is get your data right also around your current exposures and your future cyber portfolios. Make a decision around how you're going to explain your risk. What is your exposure management framework? What are you going to do it through scenarios, through probabilistic models? How does that link into your risk appetite and your ORSA? And then build scenarios out. And I think this is going to be very difficult, because scenarios will have to evolve in time, and scenarios will have to be very specific to the sort of insurance portfolio that you hold. It won't be any good doing like cat models, running a Cat 5 hurricane through Florida and doing your scenario, or running a Tokyo earthquake. Cyber scenarios will have to be much more bespoke than that. So this leads me to my last slide, which I think we've covered a lot today, so I'm just going to sort of really touch on this very briefly. The market will grow, there's no doubt about it, also because it's a big opportunity for insurers, and it's an opportunity that I think is also very ripe for disruptors. I wouldn't be surprised if someone from outside of the insurance space begins to play a similar role to what insurers are doing in terms of offering some kind of liability cover. And I think it's clear, I think the insurance should get very close to the detail. This is a technical risk, so there'll have to be a significant upfront investment. What does this mean from a supervisory perspective? I think in a few words, you have to pair with the industry. There's a lot of the quantification is very uncertain right now, but also I think on the positive side, Solvency II and other similar regimes actually have got the insurance industry quite well equipped in terms of explaining uncertainty, explaining expert judgments. Even if you do hear we have quantified cyber risk, there'll be a lot of expert judgment behind that. And I think a lot of what companies have been doing around Solvency II will help explaining and framing that. So I think I'll close here because I know I've got to make some closing comments at the end, but that's...
Thank you, James Dom. So I have learned a lot from private sector. Now I turn to John Huff, and he will give us some supervisory perspective, I guess.
Great, thanks Takashi very much, and let me thank IAIS for the opportunity to be here. I will tell you it is a great pleasure to be in this beautiful city, and every money machine I go to has my name on it. So you see Euro and Huff on everything. So if you haven't had that experience, find a country that will suit you. So we're all clear that some devastating impact by cyber risk that are out there. And let me just tell you, U.S. insurance regulators are taking our responsibilities very seriously on the responsibility we have to our regulated entities. And let's face it, insurance companies have the best data, right? They have all the good stuff that the folks that are hacking want. So they have all the best personal information on medical, they have all the financial information for consumers, and so in many respects, insurance companies are very viable targets and are clearly going to be victims in the cyber war, if you understand. Now, the flip side, of course, and many of the panelists have talked about it, there's a tremendous, because of all this pressure, and I think somebody had on their slide 90%, Dom, you had 90% of the exposures in the U.S. So all of this uncertainty is building, and every time you see an article or a business leader sees an article on these cyber risk, you're creating demand for these insurance products. You know, we're a pretty litigious society, so people are watching very closely what's going on in the courts and some of the settlements here on some of the cyber risk. But what we're seeing is a great pent-up demand for insurance coverage. Now, I sat outside 30 minutes before this panel started, and my clip services from the U.S. that give all the insurance industry news, the top 2 articles just 30 minutes ago were cyber related. So that's why we can't get enough of this information that's going on in cyber. The 2 articles were, one, telling businesses, don't think that insurance is going to cover you for all this. There's not enough insurance coverage out there, and insurers are approaching this very cautiously. The second article was a fascinating statistic. Cyber breaches, 60%, so the majority of cyber breaches happen in less than 3 hours. The flip side is that 62% of cyber breaches take several months to discover. So this lag time, that's a new data point, and insurers are going to have to roll that into their processes. So what are we doing about it in the U.S. in terms of the regulatory side? So we have several U.S. initiatives. We kicked off a cybersecurity task force back in late 2014 before we had some of these large insurance company breaches. Let me just tell you one thing about cyber. Probably more than any other area, this is a place where regulators have to work collaboratively, and we are doing that in the U.S. I'm so pleased to say that the federal government and state governments are working very closely together. We're very active with the Obama administration. The states are representative on the FIBIC committee, which is the U.S. Treasury Financial Banking and Information Infrastructure Committee. Deputy Secretary Raskin is leading that effort on behalf of the administration, and she says state regulators are the cops on the beat. So this is a place where we have commonality, and we're really working in a collaborative fashion, and there's a real need for it. So if you think just about a basic cyber attack, what if there was a cyber attack on an airport, for instance, in the U.S.? You would obviously be involved, or a cyber attack on a power grid that would impact an airport is a better example. So you'd have energy regulators in the U.S. involved. You would have the aviation industry and all the regulators that go to the aviation industry, and of course the insurance regulators, just at a bare minimum. So we can't overstate this need for us to communicate and work together. So these are the initiatives, and I'll go through some of them in a little bit of detail just keeping track of my time here. So right after we formed our cybersecurity task force, we set out 12 principles for effective cybersecurity insurance regulatory guidance. That's really the framework of where we're going to do all of our work. And then we went into the roadmap, if you will, for consumer cyber protections to describe the protections that we think already the NAIC believes that consumers are entitled to from an insurance company or an insurance producer and any other businesses that collect and maintain and use personal information. So we did that in October of 15, and the roadmap was adopted by our entire membership just last December. And then we went into working on developing and updating our protocols for guidance in the what we call the Financial Condition Examiner's Handbook and our Market Regulation Handbook. So how are we going to look at the way insurance companies treat their data as when we go in and do their exams? And so prior to this year, our regulatory reviews of an insurer's IT system involved a 6-step process involving security controls that was dated. And in 2016, we made changes based on the NIST framework that some of the other speakers talked about. And again, we focused on the identify, protect, detect, respond, and recover. And so these exams starting this year from year-end 12/31/15, that's the standard that we're using right now. And it's important that we then train our financial examiners as we go forward to make sure they know what kind of issues they're looking at. And a big issue, of course, is third-party vendors, which you can't overstate the significant exposure, which is ironic in this world where we're trying to go to more digital formats where you want people to interact with you and you want third parties to contribute to your business model. That's creating a great deal of cyber risk. So there's some challenges there, certainly, indeed. So if we go to, let's see, did I skip a slide? Is that possible? Yeah, I did not go into, I went into the exam protocols, but I'm sorry, I did not go into our new supplement, which this is an exciting new area because you've heard all the speakers talk about there's not much data out there on what kind of coverage is being written. So as you know, we do annual blanks and quarterly reporting for all insurance companies that do business in the U.S. And so what we've added to our annual blanks was the cybersecurity supplement for us to start collecting what information's out there. Now, I'm not ready to release that information to you today because we're still analyzing it from year-end 15, but we're seeing some early indications, and it validates what you heard from some of the speakers. Particularly what we're seeing is an embryonic market, but we're seeing about 80 insurers that are writing standalone in the U.S., and so far their premiums have been about $1 billion in written premium recorded. So this supplement will really help us as we track this growing market. And we have to do some supplements to it as well because this does not include, for instance, foreign surplus lines. So all of this is driving us to what we're working on, which is our insurance data security model law. We exposed this just a couple of months ago in March of 16. This will likely be considered for adoption this year. We're having a large number of stakeholder meetings. We were in a comment period. We had an interim meeting. We had our spring national meeting in New Orleans. We took comments. We had an interim meeting of our membership and took more comments from interested parties. And so the draft model is out there, and this is really the areas that it's focusing on. It's so important that we decide as a sector how we're going to regulate and what are the rules of the road for insurance companies and regulators. So the 4 major areas of the model, all of this is available online. We encourage people to comment and give us feedback. We have one draft out there. We're getting ready to release another draft. back, so hopefully you'll see a new and improved draft. But really, we're looking at it in 4 buckets. Get some common definitions. You heard this from some of the other speakers. What's the information security program? What are the requirements for the insurers to have, or agents to have in their program? What's the board of directors' role and the use of enterprise risk management to define these risks? And again, this emphasis on third-party service providers. Consumer rights will be a big issue for us. As you know, it's our #1 job in the U.S. as insurance regulators, policyholder protection. What are consumers' rights pre-breach? How do insurers have to treat consumer data before there's a breach? Post-breach, what are the rights and responsibilities? Investigations, and a real important issue, notifications. This is an area where today we have a patchwork across the U.S. because we did not have any national standards, and the states came in and built a patchwork of breach notifications. And that's why I'm so energized by this model, because I think it's an opportunity for the insurance industry to have some consistent regulation across the U.S. Now, this will take, it's going to be a heavy lift once we reach a landing on the model. But then the final area is the regulator's role. What's the commissioner's power for hearings, witnesses, examination authority under cyber? But this is a significant opportunity for consistency for the insurers and for the regulators. So I'll yield back the balance of my time for the Q&A. Thank you.
Thank you, John. So thank you, panelists, for the very informative and enlightening presentation. So before opening the floor for question and answer, and I take the liberty of posing some questions to the panelists. First, I have a question to Maya. So I think you touched upon both the operational risk aspect and underwriting risk aspect of a cyber risk. And so my question to you that, in your view, what are possible immediate responses to cyber threat? For example, what can be done in order to enable information sharing between different parties in order to increase cyber resilience in the insurance sector or financial industry as a whole? And also, what are the countries' biggest challenges for insurers to underwrite cyber risk?
Have a green button, or can you hear me? It's on. So I think to answer your first question, I think the insurance industry, they need to do the same thing that we preach actually to everybody else. We need to go through this risk management process ourselves. We need to identify those critical assets that we have, and then do the whole spiel, have an emergency response team in place, etc., etc. We are not exempt from that, so we should do the same thing. In terms of what does it, how can we improve overall cyber resilience? I think information sharing is actually a very good option, and it is already happening in terms of threat information and incident information. You have the FS-ISAC, you have in Switzerland the Melanie, you have different bodies that already allow for sharing of information, but I think that can be improved hugely with different data. And I think this paper that I mentioned, that will actually be published next Monday from the CRO Forum, that is one of the opportunities that we have now in order to have a common ground, to define a common language, which will allow for even more data sharing. And I forgot the last part of the question.
Second question is, what are currently the biggest challenges for underwriting cyber insurance?
Okay, I think I've touched on it. I think the data aspect goes in there, and then it has the whole a tail of the accumulation underlying. I think we have a lot of ground research to do in terms of accumulation. We have a lot of basic reinsurance and insurance technical work to do in terms of defining the wordings, because currently also, I mean, there are overlaps, right, between different insurance covers, and then there are holes. And then I think we've mentioned it earlier, we also would like to have insurance covers that are actually needed by the people and by the companies. So I think there is, it is an emerging market still. It's a market that is very much in development right now. And that makes it a very, very interesting field, actually. But yeah, there are many challenges. Data is one, accumulation is the other, and the right products, I think that is still one of the ones that we still have to tackle. Comes actually with, maybe some more flexible products that will allow for this changing threat landscape as well.
Thank you. That's very clear. So I have a question to Rob. So you mentioned that cyber risk is a wicked problem, and I think you underlined the importance of cyber resilience. But on the other hand, I think strengthening the cyber resilience could be costly. And for insurance company, for example, that may result in higher pricing of insurance products. So my question to you is that, in your view, how could we strike an appropriate balance between cyber resilience and the cost effectiveness for insurance companies?
That's a really good question, I think. I get that question a lot myself when I ask for budget. So I think one of the big things about the balance is there's certainly baseline things you need to do. You need to align to certain frameworks. You need to obviously do what your regulator tells you need to do. That's the baseline, right? But a lot of the tools we invest in, especially in financial services, are really, really expensive. To deploy for IRI properly might cost you £1 million. And in the insurance market in particular, and I learned this having previously worked for an exchange where we had slightly higher profit margins, £1 million of an investment is a big deal. So I think one way things could change is more to your point, the information sharing is big. It's also probably sharing our teams a bit more. So I know for a fact the Barclays CISO has said at the Financial Times event last year that he would love to loan his red team out to other companies. I would love to do the same kind of thing if I could. We have difficulty doing that though because of legal requirements, the risk of loaning out staff that might find something. So I think we need a bit of flexibility with regulators and others to give us the opportunity to do that kind of thing. The last thing I would say is wage inflation is big in my industry. I mean, I typically lose people. When I was at Euronext, most of my guys in their 20s would get 50% raises to leave. Not quite the same in insurance, but similar. CISOs as well, not speaking about myself obviously, but often get rated for 100% raises. And so the problem is the best people get rated. And so I think it's a race of talent to the top banks. So Barclays, for example, has 800 people, I think. They definitely hire some of the best. And I think the problem is you're creating two tiers of security, which is a bad model, I would think, for regulators too. And so again, I think it gets back to possibly sharing staff, or maybe even changing the way we do our own models. So maybe it's instead of hiring our own cyber threat teams, maybe we have shared teams, because you want the best of the best. The best guys will be able to tell you if it can be breached in about a day of work. The average guys will take a couple months and never find the problem. So these guys are worth the money. But if we don't share these resources more, maybe with regulators helping us, I think the problem's going to get worse and worse.
Thank you. So I have one question to Dom about the cyber insurance market. So we all know that there's a growing awareness of cyber insurance, but I think that in your presentation, the cyber insurance market has only developed in the United States so far. So does it mean that the companies are underinsured in other parts of the world? If yes, please explain how we can improve the situation. And also, how do you foresee the cyber insurance market worldwide 5 years from now?
Thanks. I think we've heard all the panelists today say that there are lots of new technology connectivity risks that will only mean that cyber insurance will increase as a risk, and I think as a regulatory also incentive to get insurance will also be one of the determining factors. So data protection will come on stream in Europe in 2018, and lots of insurers are preparing for a surge in demand around that. And Anna Maria presented some stats around that. PwC's own work, sort of own assessment says that in 5 years' time, the market will grow from the 2.8 billion where it is now to 7.5. Now these are just assessments. It could be more. It could be less. The point is that the demand will continue. Your second question around what is the best way to ensure that the risks become insurable. I think that is the key issue, and we've heard lots of different ways of looking at that issue today. I guess I'm going to put my modeling hat on, and what I see currently in the market is a very wide and fairly unstructured ranges of approaches around building common scenario approaches and a currency to exchange risks. I mean, I guess I go back to the CAT modeling analogy for natural catastrophes. What really helped that market was that there was a trade in currency. There was a way of transferring all the way up to the capital markets, a way of explaining and expressing risk. I think for cyber that is difficult. It is more difficult than it is for natural catastrophes. But I think the capital required will be capital that we should be expecting from the capital markets as well as from traditional insurance. And we know that cat bonds only came about because they could be traded and they could be measured. So that I think has got to be a focus. And I think the data collection exercises will be a part of that.
Thank you very much. So also a question for John. And so you talked about the many NAIC initiatives on cyber risk. And then, so do you believe that the NAIC insurance data security model law will be adopted this year? And if yes, will it be an accreditation requirement for the U.S. Insurance companies?
Those are good questions. Let me give one other point, though, before I answer the question. Just to tell you how firmly I believe in the power of insurance underwriting. So if you think how workers' comp coverage and liability coverage in the U.S. made the U.S. workplaces the safest place today than they've been forever. And the reason workplaces are safer today is because of insurance underwriting and the best practices that insurers pushed on to businesses to make those places safer. That's the opportunity for cyber. And the way we will address cyber resilience and make our businesses better prepared will be this underwriting process that as we continue to communicate with one another of the best practices we're seeing. I think our data security model law is a very important step for the entire insurance sector, consumer groups, regulators, and the insurance industry, because it's an opportunity for us to treat our sector differently than all the other cyber risks that are out there, and I think our risks are unique. So I'm hopeful that we'll reach a landing on a model law yet in 2016, and I think we'll have a very robust discussion. So for those of you that don't know how we push a model law through the U.S., if there is a characteristic on a model law that we decide as an organization that it's an accreditation requirement, that it's a mandatory requirement for the states, then that becomes pushed through each state, and a state has to pass it or risk an accreditation lapse at the NAIC. It's a very effective tool. We just did it on Model Holding Company Act changes, and now we have Model Holding Company Act revisions in all 50 states. So I think we'll have a robust discussion, because I think you can make the link between cyber risk and the financial viability of our insurers.
Thank you, John. So now I have reserved a very big question for Anna Maria. So I think you mentioned some industry initiative that could prevent the cyber risk or that could support the cyber insurance. But in your view, what could the public sector do in this front? And so maybe you have a request to the insurance supervisor or a government side?
I think what the regulator and the government or the public sector can do is support the industry in the steps they take, like, develop the standards, develop the good practices, the common language. But also, if you look into the size, the enormity of what the risk can lead to, it may be worthwhile to look into public-private partnerships with governments as a lender of last resort, because you really have a country, I think the UK looked into that, what could happen if the grid goes down. You come to claims or damages that you cannot finance by the industry anymore. So that's an issue to look into as well, I think.
Thank you very much. Now I'd like to open the floor for a question, and so we have some time, I guess. And so if anyone has any question, please raise your hand. It seems to be I think your answer to my question are very clear, and so you are already okay with that. But any question? No. Okay, so it seems to be things are very clear, and we have learned a lot. Okay, so before closing, I'd like to ask each panelist to highlight the most important issue to be tackled in the future, because the issues are still there, and we don't have a solution so far. But I think each panelist have its own view about what we can do in the future. So please give us a brief but a strong message. So Anna Maria, you are first.
Yeah. To me, it is very much the data and the modeling issue. Really get into grips with that and follow the evolvement of the risk and how you can model and do it.
Okay, Maya?
Yeah, I'll actually subscribe to that, and it's an appeal wherever you can help make this data categorization a reality in companies, or ask for it. That would be great, because it would give us the opportunity to also get a grips on that potential accumulation of that risk, and that makes it then an insurable risk.
Okay, Rob?
I think for me it's just simply finding a balance between standard and best practice, and allowing companies to still be creative and do their own thing. A really simple example would be, if you think historically, every castle that set a defense up always had different tactics. I am worried a bit that we're moving towards a world where there's a supposed best practice, which will simply give hackers a blueprint as to know exactly what to do. They do read all the frameworks. They do study what we think is best practice. Hackers do not think in a structured way. Think very different than, I suspect, all of us. And so keeping that balance, and also not giving boards and executives false hope that if they follow what, say, a regulator says or a standard, that it means they're safe. I think it's that balance.
Dom?
I think my final thought is really about the societal role that insurance has here. I think it was one of the points on my slide that I didn't say because I left until now, but I think as companies want to invest in a more connected world, we know that will make us all more prosperous. It's just a sign of advancement in our wealth, and I think the financial protection that the insurance can give, I think, is just a vital part of that. So it's just something that the industry has got to face head on, and it's their responsibility. I think it's our responsibility.
Thank you. And John?
Finally, I would just close out that this is such a moving target. We have to, on the standard side, and the requirement side, we have to build models that are flexible and scalable and not prescriptive, because we can have regulatory guidelines today that are going to meet the demands even of tomorrow. So we really have to take this at a level that will always be flexible, and we don't have to come back and continue to try to fine-tune it. And I can't stress enough the need for us all to continue to communicate on this, because this is one issue that we're all going to be able to learn from each other, I think.
Thank you. And I think my takeaway from today's panel that the private sector and the public sector partnership is essential, and we should continue our dialogue like this from now. So thank you very much, and thank you. And so please give a very big hand to the panelists.
Thank you very much. It's an excellent panel in the end of the day. So I just have some housekeeping announcement, but just few remarks of the last panel. This is also from the heart of our association. And I just noticed that, Maya, your presentation is extremely clear with visual. So what I take away from your two phases, so insurance industry has a huge opportunities. Not only we are facing, every sector face this operational risk, but we have an opportunity as an industry, have an opportunity to underwrite this risk. And industry has an opportunity to combine two risks and accumulate expertise. And Robert and Don, my takeaway from your comments is now industry is providing not only insurance product, but solution as a package. And Don, you stressed that now 2.8 billion, but it will soon, next few years, 7 billion industry premium. So it's a huge opportunity. And as you stress out, John, my takeaway is US is now very much prepared as a regulator because of industry, 90% of premium is from US. But as Anna Maria, you stressed that it will come to Europe because this notification, breach notification, 2018, it will be Europe and around the world. So if industry have to notificate the breach of this data breach, it's a huge obligation. And of course, one word I heard that, cyber risk, there is two issues if they don't notify. One is they are not aware. The other one is they are aware, but they don't notify. So any companies are now is very much exposed to cyber risk. And that's a critically important. And my takeaway from particularly US side is now NAIC, and thanks to your leadership, it's very much advanced, and not only as an industry regulator, but also as a country. But now as an international stage, because this is not a US issue, but a global issue, and it's coming, and just I want to make clear as an association of IAIS, we just issue cyber risk issues paper, and we are ready to face this challenge. And what we are going to do is analyze US example, industry's practice, and using our ICPs, insurance core principles, and consider not only risk assessment, but governance, international cooperation, coordination. That's critically important as you do within the United States. We need to cooperate, collaborate with industry and regulators together to face this risk and opportunities. So with that, thank you very much. It's an excellent panel, very fascinating topic, and huge positive, tone. I really appreciate this final panel. So with that, today we'll finish this session. And of course, we deserve drinks. We deserve to be relaxed. And yes, Stephen just announced that now drink is awaiting for you. So just please relax and have a good drink. And tomorrow we will start 9 o'clock punctually. So thank you very much for the whole day. Thank you.